Hey everyone, this is the Entrep Guru, Avinash Ramsabag, and I'm here to run through cash flow statements with you. What is a cash flow statement? So it highlights the liquidity of a business, and therefore it shows whether a company can generate enough cash in order to sustain itself. It also reveals how cash moves through a business, and we would look at it now in terms of operation, investments, and financing activities. So as I indicated before, the first area that we look at is cash flow from operating activities, and this deals with the day-to-day business operations. In addition, we also have cash flow from investing activities, and these deal with the buying and selling of fixed assets. We also have cash flow from financing activities, and this deals with borrowing, repaying of debts, and any investments by the owner. The formula that is used in order to calculate our net cash flow is cash flow from operating activities plus cash flow from investing activities plus cash flow from financing activities. Now, what this should be able to give you is the change in cash from the beginning of your accounting period to the end of the accounting period. We start with our step-by-step guide. Step 1, our cash flow from investing activities. And this is the core business, exactly what the business is involved in. And therefore, what we start with is our net profit. And if we take a look at our net profit as 15,600, this actually runs in line with our worked example for our statement of comprehensive income from before. And then afterwards, we add our non-cash expenses of depreciation, which is $3,000. Now, why is depreciation added back? We are dealing with a cash flow statement, and cash flow statement, as the name says, it looks at whether or not cash is coming in or leaving the business. Now, depreciation is considered to be a non-cash expense, and because of that, then we are adding it back to our net profit in order to get cash itself that would have left or come into our business. After we have added back depreciation, we adjust for changes in working capital. In this case, we will minus an increase in current assets or a decrease in current liabilities, whereas we will add a decrease in current assets or an increase in current liabilities. Pay attention to which one is increasing and which one is decreasing. Now, why is that? For example, as you would see here, if our accounts receivable is increasing, that means that we are not getting the cash that we should have gotten from our debtors, who are people who are owing us money. So therefore, that is why it is considered to be a negative figure. If it is that our accounts payable, who are people that we owe money to, if that value is increasing, that is why it's considered an addition, because what happened, it comes like if these people have given us money. Technically, it comes like if they've given us money, but what it is that they have given us supplies and we did not have to pay for it. That is why it's counted as an addition. If we have an increase in inventory, it means that we purchase more inventory, and that is why we will minus that amount. So if it is that we have to total our net cash flow from operating activities, it will be our 15,600, which is our net profit. Add back our depreciation of $3,000 minus our 2,000 from accounts receivable, plus our 1,500 from our increase in accounts payable, minus our 3,500 from our increase in inventory, and therefore our net cash flow from operating activities is going to be 14,600. We move on to step 2 now, which is cash flow from investing activities. And as we said before, this deals with the buying and selling of fixed assets. So for example, if it is that we purchase equipment, it means that money would have left our business, and that is why it will be counted as negative. On the other hand, if we sold a fixed asset, such as our old vehicle, then money is coming into our business. That's why it will be positive. So in this case now, our net cash flow from investing activities is going to be that negative 10,000 which is money leaving our business because we purchased equipment. And then we're going to add the money that we received from the sale of the old vehicle of $4,000, leaving us still with a deficit of $6,000. So our net cash flow from investing activities is negative $6,000. We move on to our cash flow from financing activities. And in this case, we look at any loans, any stock issues or dividends, anything like that. And please remember in this case, if it is that we take a loan, some people see it as negative. However, when we take a loan, when it comes to a cash flow statement, money is coming into your business, and therefore that is why it is considered to be positive. So that's why that 8,000 there that you would see is positive. If we repay that loan or any part of the loan, then that is money that is leaving the business, which is 3,000 in this case, and that's why it's negative. And if we pay any dividends, that is also money leaving the business, and that is why that 2,500 is also negative. So our net cash flow from financing activities would be 8,000, that positive 8,000, minus the loan repayment of 3,000, minus the dividends paid of 2,500, giving us a final total of 2,500 as our net cash flow from financing activities, and that figure is positive. So our next step now is to compute our net increase or decrease in cash, which is our net cash flow overall. And as we said before, it will be our cash flow from operating activities plus our cash flow from investing activities minus our plus our cash flow from financing activities. And in this case now, it is going to be 14,600, which is our cash flow from operating activities, plus our negative 6,000, which was our cash flow from investing activities, plus our 2,500, which was our cash flow from financing activities, giving us our total of 11,100. The changes in cash and cash equivalents is another area that we look at. And all we do here is just a double check to make sure that that 11,100 was correct. Now, in this case, all we are doing is that we are taking our opening cash balance and minus our closing cash balance. In this case, our opening cash balance was 5,000 and our closing was 16,100. When we find the difference between the two, we're going to get that same 11,100 that we would have gotten before. Once we arrive at that, that means that our cash flow is actually correct. So the good part about it is that we can actually check back to see if our figure from our cash flow statement was correct in the first place. Now, this is exactly what it would look like. Please remember, again, columns. One is for working, all right, which would be the one on the left-hand side, whereas the one on the right-hand side is more for totals. So as we would see, we're putting our net profit of 15,600, add back our depreciation of 3,000. And then afterwards, we have our working here to show for changes in working capital, which would have been our increase in accounts receivable, giving us a negative 2,000, increase in accounts payable of 1,500, and increase in inventory of negative 3,500, giving us a net cash outflow of $4,000. And therefore, when we total our net cash flow from operating activities, we get 14,600. Then when we take a look at our cash flow from investing activities, the purchase of equipment of 10,000 will be negative. Then our sale of our vehicle of 4,000 will be positive, giving us a net cash flow from investing activities of $6,000. We continue with the cash flow statement now with our cash flow from financing activities. We have our loan received of 8,000, part loan repayment of 3,000, so that's a negative, and dividends paid of 2,500. So therefore, our net cash flow from financing activities will be 2,500 overall. And then afterwards, our increase in cash, as we would see, that same 14,600 from before, minus our 6,000 plus 2,500 from financing activities, gives us 11,100. We make our check back by taking a look at our opening cash versus our closing cash. and note whether there was an increase or a decrease. In this case, there was an increase, and therefore it justifies that 11,100 that we were able to find for our statement. So just some reminders: our operating activities, it focuses on our core business, inflows and outflows, so it looks at the day-to-day operations. Investing activities, it looks at what it is that we spent on fixed assets or what we receive from the sale of it. Our financing activities show the movement in cash in terms of loans and shares and dividends. Our cash flow, total cash flow, is the sum of all three sections, which is cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now, the difference between the opening and the closing cash should be equal to the same total that you get from the cash flow statement itself. And finally, our closing cash balance must match that of your closing cash balance must match the cash balance in your statement of financial position, and that is your balance sheet. So whatever is in your balance sheet as your cash, that should be equal to whatever is your closing cash balance here. That's it for me for today. I want to thank you very much, and don't forget to like and subscribe to the Entrep Guru, Avinash Ramsabag, and also you can also join us on Instagram at the Entrep Guru. Take care. Goodbye.